ladies and gentlemen, an associate is any company that you have bought shares that happen to be in this range. Any investment that you make, if you invest in a company, and it happens that in this case here, your investment in this company falls within here, 20% all the way to what year? 50%, less than 50%. So if you are shareholding in a particular company, company A, if for example, company A buys in this case here, company B, and it happens that A has just bought, for example, 40% of B. So you need to ask yourself, is 40% in this range? If 40% is in this range, if 40% is in this range, then automatically that company becomes what here? An associate. It becomes an associate. It becomes an associate. It becomes an associate. Okay, Roger Miller, I'll do that. I'll do that. It becomes an associate. It becomes an associate. It becomes an associate. But again, remember, like the students who are doing advanced financial reporting, there is a time they gave us an investment in a company of about 30%. But they went ahead to tell us that, yes, we've bought 30% of company B. However, the other shareholders of company B have agreed, and they have documented this down, that they are going to give us, we who have only 30%, they are going to give us the control of the company. They are going to allow us to manage the company uninterfered. So, ladies and gentlemen, whenever you are given through some contracts here, some understanding here, you are given an opportunity 100% here to run a company, then regardless of the shareholding, you are in control. And any company that you are in control of, it becomes your subsidiary. It becomes your subsidiary. I'm so sure there are those who will be able to show you that question. Who simply got a 100% in that 100% zero in that question, simply because they ought to have accounted for that company as a subsidiary, and because they are not really quite aware of this concept of control that I'm teaching you, they went ahead and accounted for it as an associate. So they got zero. Once you confuse, when you're told that you have control over a company, regardless of what percentage you have to treat that as what here somebody as a subsidiary. You must treat that as a subsidiary. You must treat that as a subsidiary. Great. So, ladies and gentlemen, then if a company is an associate, how will you be able, if a company is an associate, how will you be able to account for it in the statement of financial position? So accounting for associates in the statement of financial, that's what we shall do today. Accounting for associates, stroke joint ventures in the statement of financial position. We normally use what we call IAS 28. IAS 28 tells us that for both associates and joint ventures, we should use what we call the equity approach. We should use what we call the equity approach. We should use what we call the equity approach. We should use what we call the equity approach. We should use what we call equity approach. So, and if we are going to use the equity approach, ladies and gentlemen, then there are things that we must always know. These things that we must always know, ladies and gentlemen, are this equity approach. Equity approach means profits. Equity approach means that our investment in the associate can only increase if we have what we call post-acquisition profit. So in short, for us to be able to get this investment in associate figure, investment in associate figure in the statement of financial position, this is what we shall be doing. We shall look at the cost of the investment. How much in this case here did we pay to buy our shares? How much do we pay to buy our shares? That's very important. And then number two, now you come and add. You add the parent share. Of PERP in the associate, that's the equity. in the associate, in the associate, in the associate. So in this case here, you come and add this. This you are adding. Very, very important. Very, very important. This you are adding. Very, very important. And then, ladies and gentlemen, if there is any impairment loss of the associate, you less this. This is eating into your profits. This is eating into your equity. So in this case here, less any impairment loss of the associate, this one here, you less like that. You less like that. And then lastly, ladies and gentlemen, we shall be lessing. You less, in this case here, the UPS. The UPS. Sorry for this. PAP. PAP stands for what in full? What does PAP stand for in full? PAP. PAP is post-acquisition profits. PAP is post-acquisition profits. Post-acquisition profits. Post-acquisition profit. Please write, I'm so sure those students who have never attended my class may be wondering, this PAP. This PAP stands for post-acquisition profit. Post-acquisition profit. And then you less UPS. So UPS stands for what here, somebody? UPS in this case here stands for unrealized profit on stock. Unrealized profit on stock. But now, ladies and gentlemen, which unrealized profit on stock do we subtract from the associate? Which unrealized profit on stock do we subtract from the associate? Remember, in net assets, and I'm repeating myself on this, in net assets, we always subtract upstream, UPS. If you remember, upstream, downstream, right? So in net assets, always you use upstream. But under investment in an associate, here we can only subtract if this UPS is obtained through a downstream, through a downstream. If I were you, ladies and gentlemen, I would write this downstream and highlight it using yellow color. It's only yellow which works. In terms of conspicuousness, it's only yellow. It's only yellow that works. That for investment in associate, how I wish I was a musician. You know, these musicians in this case here know, they really know how to come up with the lyrics, especially on the choruses part, which people are able to, even if you know nothing, when it reaches to that particular chorus, you'll always get a person singing very well. So if I were you, in terms of a chorus, ladies and gentlemen, I would have even written somewhere in my mother tongue that under investment in associate, we shall be subtracting UPS if it is what here? Downstream. Downstream means parent selling to the associate. So parent to, I can even write here, parent to associate. Parent to associate. Parent to associate. So these you must do what here? This you must come and do what here, somebody? This in this case, ladies and gentlemen, must be understood. Parent selling to associate down here. Parent is bigger. So the river is flowing downstream. The river is flowing downstream. The river is flowing downstream. So in this case here, you less like this. You less like this. We'll get other things, but of course, these ones are the general ones. These ones are the general ones. So whatever you get here is what we shall take as the investment in our associate. Investment in our associate in the statement of financial position, this figure here. So remember, our aim, ladies and gentlemen, in this case here, I can't understand what Leshamta is saying, but we shall overcome. So remember, this is the question that I would want to do. This question is the one that I would want to do. I would want to calculate what year the investment in associate. I started doing this question in last class. And if you check my YouTube video up there, you'll be able to see how I did this particular question up to especially consolidating the subsidiary. But now today, we would want to simply concentrate on accounting for associates. And I would want us to do some small exercises here before we look at the lengthy question. Now, my question is, up to where we have reached, are we really together? Have we been able to write down this working for investment in associate? Have we been able to write down this working for investment in associate? Please give me responses there or ask questions. Ask questions, please ask questions. Hakuna UPFA. Okay. Okay. Great. So thank you very much. So then I would want us to look at this question here. Or rather, Leshanta, we shall be able to see. What if, for example, in this case, it's a downstream transaction where the parent is the one that has given this fixed asset to who? To the associate. We shall be able to get these examples as we get along. So let's look at this. Or UPS stands for unrealized profit on stock. Unrealized profit on stock. Unrealized profit on stock. Great. So question number one. Question number one, ladies and gentlemen, question number one reads as follows. On 1st October 2018, Pacemaker acquired 30 million of Verdin's 100 million shares in exchange for 75 million of its own shares. The stock market value of Pacemaker shares at the date of this share exchange was $1.6 each. So I would want us, you see, Pacemaker is in this case here the investor. Pacemaker is the one that has invested. It has bought 30 million of Verdin's shares, and Verdin shares has got what here? Somebody 100 million. So percentage-wise, then Pacemaker, percentage-wise, Pacemaker, percentage-wise, Pacemaker, percentage-wise, Pacemaker, percentage-wise, Pacemaker, percentage-wise. So in this case here, group structure. So we have here Pacemaker has bought Verdin, and they bought 30 million shares, and we are being told in this case here they had 100 million. So then automatically this is what here? 30%. And if it is 30%, ladies and gentlemen, shareholding, in light of no further information about as to whether this company has been given other, for example, yes, they have a smaller percentage, less than 50%, but if they are given control by the other shareholders, the shareholders sat in an AGM and said, out of the 5 directors that we have at Verdin, the new guys will appoint 4 directors. So when we have 4 out of 5 directors, honestly, will be the ones in this case here calling shots, will be the ones in this case here controlling the company. So in terms of the quantitative threshold, 30% is well within 20%, but less than 50%. So it means that Verdin is an associate. This 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 is an associate. I can see some comments here. Oh, sorry, Nancy, already now this is off. Sorry for that. But we shall repeat because I'm going to use the same. So if it's an associate, then I would want us to, measurement. I would want us to pick the figure of Verdin that we shall take to our balance sheet, that we shall take to our statement of financial position. Like, look at the question here. Look at the question here. If you look at the question, ladies and gentlemen, we are told here what amount will be shown as investment in our associate in the consolidated statement of financial position as at this date. Now, remember, we were told here the stock market value of Pacemaker shares at the date of this share exchange was $1.6 each. Verdin's profit is subject to seasonal variation. Its profit for the year ended 31st March 2019 was 100 million. 20 million of this profit was made from 1st April 2018 to 30th September 2018. Pacemaker has one subsidiary and no other investment apart from Verdin. Then what amount should we recognize as investment in associate at the end of the year? Remember that this particular, ladies and gentlemen, Verdin investment in Verdin was done on 1st October. The date of acquisition here, is 1st October 2017. Is it 2017 or 2018? I'm not so sure. I have to check again. So if you look at this, 2018, that's when we bought this. And then, of course, the date of the financial statements provided, the statements provided, date of financial statements provided, they're giving us here, end of the year is 31st March 2019. 31st March 2019. That's when they want us to provide that figure, 31st March 2019. 31st March, is it? 2019, is it? So go and check this again very well. The dates are very, very important here. The dates are very, very important here. So whatever we have, ladies and gentlemen, here, on 1st October, we acquired this. Yes, in share exchange, no problem. So Vardine's profit is subject to seasonal variation. Its profit for the year ended 31st March 2019. 31st March 2019 was 100 million. And 20 million of this profit was made from 1st April 2018 to 30th September 2018. So Pacemaker has one subsidiary and no other investment apart from Vardine. So, ladies and gentlemen, I would want us to look at this profit very well. So the profit here. So they have told us profit as at the date of financial statements. This profit as at the date of this financial statement is what here is this one here is 100 million. But when you look at this question very well, they are telling us that part of this 100 million is pre-acquisition. Part of the 100 million was generated before we acquired the associate. Part of that 100 million is before we acquired the associate. And they're telling us very keenly here. They're telling us very, very clearly, here. They're telling us that Vardine's profit is subject to seasonal variation. Its profit for the year ended 31st March 2019, which is our statement of financial position date, was 100 million. And then they are telling us that 20 million of this profit was made from 1st of April, long time ago, 2018, to 30th September 2018. All right. So, ladies and gentlemen, meaning that this 20 million is not ours. The 20 million is not ours. The 20 million is pre-what year? Is pre-acquisition. The 20 million is pre-acquisition because we made that money long time ago. So then I would want us to appreciate one thing. Look at what I will do in this question. Look at what I'll do in this question for Vardine. What I'll do in this question, in getting the investment in an associate, it's very easy. The investment in associate, this is what I will do. I will come and look at the cost of the investment. Right? Then I'll come and add, in this case here, what we call post-acquisition profit, and we are only going to take our percentage. So the post-acquisition profit here, remember, by the end of the financial year, we had a profit of 100 million. And if you can recall very well, 20 of this was not, in this case here, ours. 20 of this is pre-acquisition. But now remember that here we can only recognize our percentage, and the percentage of the parent for this in this associate is just 30%. It's 30%. So can somebody in this case here give me this post-acquisition profit, our percentage alone as the parent? Our percentage alone as the parent. What do we have? Now these things will start flowing. What do we have? So the Shamta tells me it is 24. So in this case here, the post-acquisition profit is 24 like that. Remember, in this case here, we do not have any other information about impairment in the associate. We don't have any information about the parent having sold goods to the associate. So nothing. The only thing that I would want you guys, you clever people, to give me is the cost of this investment. At the date of acquisition, how much did we pay to be able to acquire this particular associate? At the date of acquisition, how much do we pay ourselves to be able to acquire? How much do we pay ourselves to be able to acquire this investment? Is there somebody who can give me this answer? Is there somebody who can give me this answer? How much do we pay? Remember here we paid in form of shares. We paid in form of shares. So we must look at the parent gave how many shares out. The parent gave how many shares out. Because we paid in form of shares. We paid in form of shares. So the parent gave how many shares out. These guys today, they are not so happy. I don't know why. I don't know why. I don't know why. The parent gave how many shares here for this exchange to buy. So in this case here, we are told that on 1st October 2018, Pacemaker acquired 30 million of Vardina's 100 million shares in exchange for 75 million of its own. So it gave 75 million shares. So it gave 75 million shares. For me to be able to factor in this very well, I will need to know the value of these shares. The parent shares on this date of acquisition, the parent shares on this date of acquisition were going for 1.6. At the date of this share exchange was 1.6. So instead of giving these guys cash, we gave them our shares, and these shares here, each was worth 1.6. So can you give me, what is 75 times 1.6? 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 So they're giving me a figure of 120 million like that. And that is it. So the total here is 144. And this is what I will take as investment in who? In associate, in the statement of financial position, consolidated like that. Because there is nothing like impairment of the associate. There is nothing like a UPS downstream. Unfortunately, these books, which you happen to be having, ladies and gentlemen, you can always go here and check the answer. You just make a duplicate. You can go here and check the answer So like now for this one, what is the answer here for this one? What is the answer for this one? If you're keen enough, you'll be able to see the answer. Yeah, like now here. Very easy, really. Very easy, really. So then I would want you guys to go straight away ahead and do for me number three. And now this one is something that I should be able to give out a present to the student who will be able to get this very fast, very easily. For us, you should be able to get a present here. Question number 3, we are competing. Question number 3, there is a present. Question number 3, there is a present. Question number 3, there is a present. For question number 3. For question number 3, there is a present. Okay, so anybody who has already gotten an answer? I don't think they want my present today. They don't want my present today. They don't want my present today. For the students in this case here who are here, and maybe they are here for their very first time, I would want to take this opportunity to welcome all of them to RCM Online College. All right. So, of course, we teach all CPA papers. We teach all CS papers. We teach all CIFA papers. Like if it's CPA papers currently, of course, you don't know how the future will be, but currently you're charging 4,200 per paper and hours is a sure bet. You'll pass very easily. You'll pass very easily. You'll pass very easily. Great. Great. So I can see students, ladies and gentlemen, who are mentioning a figure there. Let me give them 1 more minute. So of course, for the new students who would want to join us, don't hesitate calling us today. Our number is 0793 555 000. 0793 555 000. You should be able to get our pay bill number. We want to formally welcome you around as a paid up student. You can't go wrong with us. Okay. So I don't think there is anybody who is writing anything. So I would rather do this question. But wait, I have to get like 2 of them. At least Irene has gotten purple. So let's check the answer. Thank you very much. Let's check the answer. Let's check the answer. So if you are able to see the answer here, what do we have? What do we have? We have in this case here, this amount. I don't think there is anybody who got this correctly, really. Is there anybody who got this correctly, really? Question number 3. I doubt. It's 2787. 2767, I mean. But you've really tried. You've really, really, really tried. You've really, really tried. So, ladies and gentlemen, this is what we have. We are told here in note number 3 that Wellington owns 30% of Boot. So meaning that Boot is an associate, which it purchased on 1st May 21, on 1st May 2017 for 2.5, so 2,500. At that date, Boot had retained earnings of 5,300. So this is pre-acquisition. This was generated before we have, so this money is not ours. So this has to be subtracted from our PAP calculations. At the year end of 31st October 2017, Boot had retained earnings of 6.4. So the year end, they had retained 6.4 million or 6,400. But this is after what year? After paying a dividend of 1 million. Fortunately, they have already subtracted. If they are not subtracted, I would have subtracted dividends. I would have subtracted dividends. Here they have already subtracted. So this dividend of 1 million is noise. We shall not capture it anywhere. So on 30th September 2017, Wellington sold goods worth 700,000 to Boot, which it made 30% what year profit. So they've given us profit margin. Boot had resold none of these goods by 31st October. So, ladies and gentlemen, they want us to give them the amount that we shall be able to record Boot, who is our associate, in the consolidated statement of financial position. This I will get all the marks. I know here that this intra-sale is downstream. This intra-sale is downstream. Why am I saying it's downstream? It's Wellington that sold to who? Wellington that sold goods to Boot, to the associate. So it's downstream. It's downstream. And if it's downstream, for sure, I'll have to do that working first. I'll have to do that working fast. I'll have to do that working fast. I need that working of UPS. So I'll come here and say, I'll come here and say UPS and realize profit on stock. I know to get this, we normally take the profit margin times REES. REES is remaining intra-sales. REES is remaining intra-sales. It's remaining intra-sales. REES is remaining intra-sales. So, ladies and gentlemen, like in this question, the goods that we sold ourselves, or rather the profit margin here is 30%. The profit margin is 30%. Profit percentage as percentage of our profit to sales, 30%. That is the profit margin, right? Times the remaining internal sale. The goods in total, ladies and gentlemen, that we did sell between ourselves, we are told here. The goods that we sold between ourselves, we are told here. We are told here that Wellington sold 700,000 of goods to Boot, on which it made 30% profit. 30% profit. Boot had sold none of these goods. So 700,000, I can just capture this as 700. So in this case here, 700 minus the goods that we had been able to sell from the group, of which we are told in this case here that Boot had not sold even nothing. So in this case here, minus 0 like that. So then can somebody give me this unrealized profit on stock? Can somebody give me this unrealized profit on stock? Is anybody who is able to give me this unrealized profit on stock? 210, like that. 210. I don't know where they're getting 0.33 from. I don't know, because it's 30%. 30% times remaining intra sales times remaining internal sales. So remaining internal sales, remember, the goods sold between these related entities were worth 700,000. By the end of the year, Boot, our associate, had not been able to resell any of these to third parties, so 0 here. So you take 30%, 0.3 times 700,000, I believe we shall get 200 what here? 210. And then I will go ahead and write down my pro forma, investment in the associate. My pro forma here, investment in the associate. So we have here investment in associate. This will always come in your exams. Very easy. So you give us the cost of what here, somebody? The cost of the investment. Have they told us how much we paid to acquire our shares in this associate? Have they given us the amount we paid? 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 2,500. I'm cutting 3 zeros. Thank you very much. 2,500. That's what we paid to acquire our shares there. And then we shall come and add the post-acquisition profit, our percentage. Post-acquisition profit, our percentage alone. Post-acquisition profit, our percentage. Is there anybody who is able to see this post-acquisition profit really? Is there anybody who is able to see the post-acquisition profit here? Let's see. At the year end of 31st, Boot had retained earnings of 6.4. And then remember, the retained earnings pre-acquisition were 5,300. So then I'll take 6,400 minus 5,300. This is the post-acquisition profit. And remember, we are only taking our percentage, which we had computed there, which was 30%. Remember, if they had not subtracted dividend, we would have subtracted dividend out of this, because we are looking at what we have been able to retain, But here they have told us that they subtracted the dividends already. So they have done that adjustment for us. So times 30%. So are you able to give us a figure? Are you able to give us a figure? They're not talking to me. I think things are really sinking in. Things are sinking in. 330, our own percentage, isn't it? 330. And then, ladies and gentlemen, remember here, we have the famous what here? UPS, unrealized profit on stock. Unrealized profit on stock for the whole transaction. You guys gave me less UPS, our percentage. Don't forget, UPS, our percentage. So on the UPS you guys gave me here was 210. In this case here, times what here, somebody? Our percentage is 30. 210 times 30%. 210 times 30%, which gives us what, somebody there? 63. Here we are subtracting this. Whatever we get here will be our investment, in the associate, will be our investment in the associate. Investment in the associate. Why have we subtracted this UPS? It's because it's downstream. If it was upstream, I would have taken to the net assets. We shall be able to differentiate this slowly as we progress. We shall be able to differentiate this slowly as we progress. So of course, this investment in associate is what I'm taking the consolidated statement of financial position. So what is the answer? Somebody here, they are not talking to me very fast. They are not talking to me very fast. I don't know why. And I know you guys are straight away happy because you can see the answer is here. You must have seen. I know somebody must have checked the answer. I know somebody must have checked the answer. 2767. Thank you so much. Thank you so much. So up to now, are we okay really? Are we okay up to now? Are we okay? Are we okay? Are we okay up to now? Up to now, are we okay? It's normally a very simple thing. I've never understood why students don't understand group consolidation. It is the easiest. Actually, this is the question that I should always start with in an exam. Honestly speaking, if you don't understand this group consolidation, you're not able to do like all the questions of group consolidation, even in your past papers. This is it's about adding. It's about the concept, really. Once you have the concept, then everything is as easy as a walk in the park. Yes, great. So then, ladies and gentlemen, come straight away on the up stroke down stream in associate. So remember, when you are given, like now here we have our parent. And then we have, in this case here, our associate. Like now in the case here. So the river is flowing, of course, like this. When you're told the parent sold goods to an associate, that's downstream. Downstream. When you're told that associate sold goods to the parent, that is what here, upstream. If it is a downstream transaction, then the UPS will feature in the associate investment in associate. Investment in, if it's downstream. Like now here, they have told us, yes, we must apportion. Like now here, they have told us, sorry, sharing the wrong. Like now here, they have told us that on 30th September 2017, Wellington sold goods. Wellington is the parent. It sold goods, in this case here, to Boot. Boot, who is our associate. So automatically, ladies and gentlemen, this is a downstream, and if it's downstream, then it must affect our investment in associate. If it was upstream, this thing would not have come here. If it was upstream, it would have gone to a statement of net assets, Yes, great. So then we come in this case, and now we are becoming experts. Let's go to number 4. Number 4 is quite a tough one. Let's go to number 4. Number 4 is quite a tough one. Let's go to number 4. This is quite a tough one. Number 4 is a tough one. So we are told here, on 1st February 2011, Picardy acquired 35% of the equity shares of Avignon. It's only associate for 10 million. At least the cost of buying this associate has been given in cash. The post-tax profit of Avignon for the year ended December is 3 million. Profits accrued evenly throughout the year. Avignon made a dividend payment of 1 million on 1st September 2011. At 30th September 2011, Picardy decided that an impairment loss of 500,000 should be recognized on its investment in Avignon. What amount will be shown as investment in associate in the statement of financial position of Picardy as at 30th September 2011. I hope somebody is really trying to trouble their mind, because you only become smart by being aggressive, being proactive. Even if you're not understanding anything, just fight with the question, fight with it. Fight with it so seriously. Fight with it. Fight with the question. So fight with the question. Are they fighting enough? Okay, so I can see like 6 charts. Let's see. So in this case here, what I'm seeing, ladies and gentlemen, here, I can see somebody giving me a 1045, 10200. That's Irene. 10200. Let's see. Let's see the answer. Let's see the answer here. Number 4. So number 4, we can see the cost of investment. This is supposed to be 9850. 9850. Walikosea wapi? Walikosea wapi? Walikosea wapi? Walikosea wapi? Walikosea wapi? Mimi najua sana. Mimi najua what will confuse these guys. Can I do it? Can I do now the question? Can I do the question? Are you still thinking about it? They are telling me Mwalimu do the question. So this is very easy. And if we understand now this, then we would have understood everything. We would have understood everything. We would have understood everything. So then we have here Wellington owns 30% of Boot. No. On 1st February 2011, Picardy acquired 35% of the equity share. At least all of us were able to appreciate the fact that 35%, that is an associate. It's only associate for 10 million in cash. The post-tax profit, they're not saying post-acquisition profit. It's not post-acquisition. This is just the profit after tax for the whole year is 3 million. All right. Profits accrued evenly throughout the year. Whenever they use these terminologies here, profits accrued evenly throughout the year, they wanted to apportion something. Avignon made a dividend payment of 1 million on 1st September 2011. On 30th September 2011, Picardy decided that an impairment loss of 500,000 should be recognized on its investment in Avignon. So now here there are things I have to get right. I have to get right the concept of what here post-acquisition profit. If I get this right, then everything is sorted out. I must get the post-acquisition profit right. So remember, this is an associate that was acquired during the year. It's quite a tricky one. It's an associate that was acquired during the year, and they have not given you pre-acquisition earnings. They have not given you pre-acquisition earnings. So you have to compute this really very well. Remember, the financial year is supposed to end when? The financial year of this associate. The financial year of this associate, they have told us that the financial year of this associate is supposed to be 30th September 2011. 30th September 2011. 30th September 2011. So we have here 30th September 2011. And then this associate, of course, if this is the end of the year, then the beginning of the year must have been the day after today is tomorrow, which is 1st October. 1st October 2010. 1st October 2010, that is when the year began. Now let's read the question from the beginning. So what have they told us here? What they have told us here is that on 1st February 2011, Picardy acquired 35% of the equity shares of Avignon. On which date? 1st February 2011. So 1st February 2011 here. 1st February 2011 here. 1st February 2011. So could you kindly count the number of months from the date we acquired this thing to this date? Who is able to tell me the number of months? You can also get them by whichever you count. We have, we want to count the longer way. February, March, April, May, June, July, August, the whole of September. Because we're going to the end of September. Those are how many months, ladies and gentlemen? 8 months. So these are 8 months in the year. So basically, this associate was ours for how many months? For 8 months. This associate was only ours for 8 months, was ours for 8 months only in the year. And yet, they have told you that the whole profit here, the whole year's profit, they have told you that the whole year's profit was equal to what here, somebody? The whole year's profit is equal to what here, somebody? The whole year's profit is equal to what here, somebody? They've told us in the book. They've told us in the book. They've told us in the book. The whole year's profit is 3, I'm using thousands, so it's 3,000. And therefore, the profits in this case here that belong to the group is profit for 8 months. What we could call post-acquisition profit. What we can call post-acquisition profit, it will be, ladies and gentlemen, 8 out of 12 times 3,000, which gives us what here, somebody? 8 out of 12 times 3,000, which gives us what here, somebody? They're not talking to us. 8 out of 12 times 3,000. Remember, I know we are so much used to the situation where we are given pre-acquisition and the end of year we subtract. Here they did not do that. So we are getting here 2,000 like that. And then these guys here went ahead to pay dividends. They paid dividends. So when they pay dividends, we get this from the profit here. So come and less dividends paid, less dividends paid. Dividends of how much somebody were able to follow. Dividends of how much you were able to follow. Dividends of how much? 1,000. So basically then you can come and give us what we call the net PAP. The net post-acquisition profit. Because you see, we are interested in what shall be retained. If you generate profit and you issue it out as dividend, then that has really to be subtracted. That is a reduction in the associate's value. It's a reduction in the, otherwise, if you want the associate to be more valuable, then don't pay dividends at all. Retain everything and the firm will really grow. So then this gives us a net PAP of 1,000. So once I have this, ladies and gentlemen, then I'll be able to do the cost of the investment called what here, somebody? Associate. So cost of associate. Why not deduct before PAP? How? I can't understand the question. I don't understand the question. Silas, please try to ask it another way. You know, when you ask many times, I think I'll be able to pick it very fast. Remember, dividends are paid at the end of the year. They are not prorated. They are not prorated. They are not prorated. They are not prorated. 3,000 or 3,000 minus, okay, 3,000 minus 1,000. But you see, this 3,000 for the group, what are we interested in? For the group, remember, we are interested in the profit that was generated by this associate during our time. During our time. The profit generated by the associate during our time that we stayed with this associate is only 8 months. Is 8 months. Any other thing in this case here outside that is not ours. It's that associate belonged to others. Belonged to others earlier on there. Thanks for asking that question. Great. So then once we have gotten this, we shall come here and then we do this. We say cost of the associate. So the cost of this associate, ladies and gentlemen, will be the cost of this associate now here will be equal to the cost of the investment. So are you able to see the investment cost? How much did it cost the parent company? The parent company, 10,000, right? 10,000. So in this case here, 10,000. And then you come and add here, you add PAP. You add in this case here, PAP, our percentage. You add PAP, our percentage. You add PAP, our percentage. Okay, good questions are coming there. Are you able to remember the PAP? The PAP? The PAP? Are you able to remember the PAP? These guys are not giving me answers here. Are they able to remember the PAP? Abracadabra. Are they able to remember the PAP? It was 1,000, isn't it? It was 1,000. But again, remember here, you can easily confuse. Why am I saying you can easily confuse, ladies and gentlemen? It's because, remember, PAP, we only take our percentage. Our percentage. So 1,000 is what we made, and our percentage is what there is 35%. So this one here will give us what value? Thank you very much. 350. 350. Now, in this question, ladies and gentlemen, do we have any UPS? Do we have any UPS in this question? Do we have any UPS? Do we have any UPS in this question? Do we have any UPS in this question? No UPS, isn't it? However, there is what we call impairment. There is what we call the impairment loss. Impairment loss. So impairment loss, what do we have here as our impairment loss? Impairment loss. And you must have been taught this, that impairment loss, you cannot not apply your percentage. Impairment loss for the associate, you take the whole loss because it is the parent that reviews the associate's impairment. They review their own investment in associate. They review for that loss. So impairment loss, we have never taken impairment loss. We have never taken impairment loss. Impairment loss, ladies and gentlemen, we have never taken our percentage. Like in this question, the impairment loss given is 500, you're right. If we share these, the impairment loss given is 500. The impairment loss given is 500. The impairment loss given here, you can see here the way they're putting it in their language. At 30th September 2011, Picardy decided that an impairment loss of 500, Picardy, which is the parent, decided that an impairment loss of 500 should be recognized on its investment in Avicon. So don't apportion this because you never reviewed this impairment loss with the other owners. You as Picardy just looked at your investment in Avicon alone and you decided that, hey, this thing is impaired to the tune of 500, like that. So less impairment loss of 500. Like that. So then from there, ladies and gentlemen, you'll be able to come and give us what year you will be able to come and give us, the investment in associate now. Investment in associate. So the investment in associate will be equal to who? Investment in associate will be equal to who? 9850, like that, 9850. 9850, 9850, 9850. Now, let me address your questions now. Let me address your questions. Let me address your questions. Let me address your questions now. Great. So, ladies and gentlemen, here is where we are. What some people will do for you to understand this, and by the way, I think I made a wrong assumption. I must have made a wrong assumption. Have you done this topic with your teacher? Because I don't want to teach new things in AFR. I want to teach things that you guys have done in class. Have you done this topic with your teacher? Have you done this topic with your teacher? Oh, okay. Okay. No wonder then. Yes, follow. You'll be able to follow. So the other way that you could have done this, is this method 2. Method 2. So under method 2, I would have come and picked the cost of the investment. So what is the cost of the investment? What is the cost of the investment? It's 10,000. Thank you very much. Then in this case here, I can come and add PUP, the post-acquisition profit. So remember, these guys made profits of 3 million for a whole year. But the subsidiary was, or rather the associate was only ours for how many months? For 8 out of what year? 12. So can somebody give me this? 3,000 times 8 over 12. 3,000 times 8 over 12. This gives me 2,000. But remember, we can only take our percentage of this profit. And our percentage in this case here is what here? Is 35%. So could you kindly give me this figure? 2,000 times 35%. 2,000 times 35% will give me how much? Will give me 700, isn't it? Will give me 700. And then now from there, we shall come and we know there are 2 things here, actually 3 things that will reduce our investment in the associate. The first one is dividend that is paid by this associate at the end of the year. Dividend paid by the associate at the end of the year will always reduce the investment in there. So less dividends paid by associate, less dividend paid by associate, dividend paid by associate in the year, which in this case here they have told us 1,000, but remember, it is only our percentage. It's only our percentage like that, our percentage. So we have here 35% less dividends paid by the associate, which in this case here will come to 35% of 1,000, which gives us how much here, somebody? 350, which gives us 350 like that. Great. And then we have impairment loss. And then you cram this. You know that impairment loss can never be take it. You can never take your own percentage. Impairment loss, you recognize it in full. You recognize impairment loss in full. Over how much here, somebody? 500, isn't it? 500. All right. And then now lastly, we have, of course, the UPS. Whenever it is downstream, it reduces the investment value downstream, of which in this case here we don't have it, but you can just take this as a way to just remember this. We don't have any intra-sales, downstream intra-sales, nothing really. And then now, of course, you'll be able to give us the investment. The investment in associate over how much? Investment in associate over how much? Same answer of 98.50. 98.50. So you can either adopt this approach or be subtracting this dividend from the PAP. From the PAP. You'll still get the same. Great. Great. So the tax elements, I don't know what you mean with the tax elements. I'm assuming it's because you haven't done the section. Because here really ours is to make adjustments for investment in associate. Investment in associate. Okay, great. So then come here to now the big question that we are doing as we finish this. As we finish this, let's now do this big question that we're doing here. This question number 39. This question number 39, if you remember it very well, we were given here Laurel acquired 80% of the ordinary share capital of Hardy, $4.160, and 40% of the ordinary share capital of Comic, for 70. So who is Comic to the group? Somebody who is able to see that percentage. Who is Comic to the group? Who is Comic to the group? Who is Comic to the group? Yani Comic the group ni kama mpango ya kando, isn't it? Ni associate. Very bad example. Very bad example. 40%. You ni associate. So we are done all the other workings. The only workings we were left with are two. Investment in associate, and then we have the group's retained earnings. So I would want us to start straight away with this investment in the associate. And there are things I would want really to see you guys now participating. The moment you understand this, I should be able to buy all of you lunch, especially if you are in Nairobi town. I should be able to buy you lunch. So then I would want us to do this working of investment in associate. Let's see who is the bingwa here. Let's see who is the king of the jungle. The king of the jungle. The king of the jungle. So investment in associate. Investment in associate. So investment in associate, let's see, at least one thing is very clear. And if you look at this thing, at least one thing is clear: the cost of the investment. That one everybody is able to see. The cost of the investment. The cost of the investment. At least everybody is able to see this. Cost of the investment. Cost of the investment. Is there anybody who is able to see the cost of this investment that is in Comic? 70 million. Sellers telling me 70 million. So 70, yeah? 70. It's only Sellers who has been able to see this. 70. 70. 70. So they're telling us here that Comic, 40% of ordinary share of Comic for 70. So 70. Thank you very much. 70. Like that. Aya. Sasa hapa mimi nitajua sana. I'll really know the things. I'll even cram them. Actually, during my times, and I got so many awards in Kasneb, and I even got an award in ACC. I did ACC. I remember paper P2, Advanced Financial Reporting. We used to call it Advanced Financial Reporting those days. Nowadays, it's called Strategic Business Reporting, SBR. I was number 19 globally. Number 19 globally. Not that I knew this paper so much. I used to cram at times the pattern. So like I know the things that will come here. I can even write them down. I know all of them. And then I look for them. I look for them. I look for them. Right? So for example, I know I must add what here? PAP. Add PAP, our percentage here. But you see now PAP will not be given easily, to you. Like the way we have been doing those small examples up there. PAP, you must be able to calculate PAP using the net assets approach. Net assets of Comic. net assets of comic. Net assets of comic. Leshamta, your brain is much better than mine. If I give you mine, you will not be able to become better. I want you to become better than me by far, in everything, worth-wise, everything. So in this case here, comic, net assets. So for net assets, remember it is DOA, date of acquisition, date of financial statements. Is there somebody who is able to remember the components of net assets? Is there somebody who is able to remember the components of net assets? Components of net assets, they are forgotten. Equity, thank you very much. The equity component, yes. Ordinary share capital. So we have here ordinary share capital, and then we have what we call retained earnings. Minor, let me tell you. For the associate, they'll not give you very, very many entries. For the associate, in most cases, it will be those two. It will be very hard for them to start telling you that for the associate, we have, no. In most cases, it will be those two, or when we have, in this case here, an upward UPS. But we shall overcome. Let's first of all read through. So I want to get the net assets over this associate called who? Called comic. Great. So come here. Let's try getting, in this case here, the net assets of comic. So comic, I can see the ordinary share capital is 80. So remember, ordinary share capital, I will take this at the date of acquisition and as a date of financial what year? Statements. At the date of acquisition and as at the date of what? Financial statements. And then we have retained earnings. We'll be able to get retained earnings at the date of financial statements. So retained earnings at the date of financial statements, is there somebody who is able to see that figure from the book that you guys have? Is there anybody who is able to see that figure? Retained earnings. Is there anybody who is able to see that figure of retained earnings? From the book that we have, ladies and gentlemen, I can see the retained earnings here for comic is 97. But remember, this 97 is the retained earnings at the date of financial statements, here 97. So here, the date of acquisition retained earnings will be given to you. And this examiner has given this to us. Yes, this examiner has given this to us. What has he told us, this examiner? So this examiner, what this examiner has told us about acquisition, this examiner tells us when the retained earning balances were 64 in Hardy and 24 in comic. On acquisition, the retained earnings in comic were 24. So from there, then I will try searching for any revaluations. I'll try searching for any revaluations, any fair value adjustments, touching on what here, somebody? Touching on comic. Touching on comic. So like note number 1, on 30th September 09, Laurel sold goods to Hardy for 32. These goods, so you see this is now for Hardy, right? For the subsidiary. Now we are not handling the subsidiary. We handled the subsidiary in our last session. And that particular video is on YouTube. You simply to go and check it out. These goods had originally cost $22 million and none had been sold by the year end on the same date. Laurel also sold goods to comic for cash for what year, somebody? 22 million. These goods originally cost this much and the comic had sold half of them at the year end. I really love that. That comic and Laurel is the parent, that they did some business. But this business, ladies and gentlemen, what is the nature of this business? Is that upstream or downstream? Upstream or downstream? Laurel is the one that sold to comic. Laurel is the one that sold to the associate. So is that downstream or upstream? And the moment you know how to, the moment you know how to distinguish the two, the moment you know how to distinguish the two, you will go to heavens in matters of passing this paper. Thank you so much. So it's down. Parent to the associate is down. So if it is downstream, will that affect our net assets? If it's downstream, will it affect our net assets? No. If it's downstream, it will affect our investment in associate. It will affect here. So here I can see a graduate. UPS, in this case here, downstream percentage. UPS downstream percentage. Here, net assets, we are only affected by what here? UPS upstream. UPS upstream. And as we progress, you guys will become experts here, So can you then kindly give me this UPS downstream so that we can just post it here and then we forget about it? Is there somebody who is able to see this downstream UPS amount? Downstream UPS amount. Let's see. So wanasema that in the same year, Laurel had also sold goods to Comic for cash for 22 million. These goods originally cost $10 million, and the Comic had sold half of them by the year end. So in this case here, the total UPS, I can see the total profit is how much? Somebody is able to see this. What is the total profit earned? 22 million. What is the total profit earned? 12, right? 12. Because you can see these goods, ladies and gentlemen, we sold to the associate at 22 million, and that cost us 10. So the total profit we realized, was what? Somebody here, the total profit realized is 12. But remember, by the end of the year, our associate still had some of those goods. So then the unrealized will be a half. Remember, unrealized profit is always pegged on RIS, the remaining intra-sales. So in this case, ladies and gentlemen, if you are following very well, the UPS here will be that 12 times a half, which gives me 6. But remember again here, we only take our percentage. We take our percentage. So what is our percentage shareholding in this associate? What is our percentage shareholding in this associate? Somebody, we are finishing 40%. 40%. So then can somebody give me the figure to bring here? 2.4, right? So remember, this is fake profit. So it has to be done what you deducted. It has to be deducted. So we are learning something very easy here, that if it's parent to associate, that is downstream, and downstream can only affect our investment in associate. It can never affect our net assets, never. Net assets is the opposite. If it was upstream, if, for example, this was upstream, it will not have appeared here. If it was upstream, it would have come here automatically. We shall get used to this. I'm not afraid at all, because I know the moment I take you through like 3 lessons, you guys will become experts of group consolidation in Nairobi. Great. So then we continue reading here. Now we are told here, go to note number 2. On 1st of January 2017, Hadi owned some items of equipment with a book value of 45. This is so nice. But you see, this is not affecting the associate. Note number 3. The group policy is to measure NCI at, this does not affect associate. Note number 4. Cumulative impairment losses on recognized goodwill amounted to the goodwill is for the subsidiary. It doesn't affect us at all. So then, ladies and gentlemen, the only thing now I need you to come and do is to balance your net assets. So balance your net assets. How much do we have here? 104. 80 plus 24. How about this one here? 80 plus 97. 80 plus 97. How much do we have here? 80 plus 97. How much do we have here? 80 plus 97. How much do we have? These guys are not talking to me this afternoon. I don't know why. 177. 177. So in this case here, then what is our post-acquisition profit? So our post-acquisition profit will be 177 minus 104. 177 minus 104, which will give us 70 what here? 73. like that. 73. 73. So if share premium was there, of course, it would have featured here. If it was there, it would have been maybe 60, 60, 60, 60. That would have been there. Okay, so we only need now our share. So 73 times what here, somebody? 40%. 40%. So 73 times 40%. So then that will give us how much, ladies and gentlemen? Is there somebody who is able to give me this figure? Please, they're not talking to me so nicely. I don't know why. 73 times 40% gives me how much? Remember, our share is only 73, 29.2. Thank you so much. 29.2. 29.2, like that. Do we have any impairment losses? Because impairment losses will impact on us here. In this question, do we have any impairment losses? No, maybe just for your revision, you can mention here impairment loss, 0, like that. So that is it. So please give me their investment in associate. Investment in associates. You take this plus this minus this. If this was there, minus. You give me investment in associate. How much are we getting? So we have a HB giving me a figure of 96.8. Remember, all our figures were in millions. In our last class, all our figures were in millions. All our figures were in millions. And you can see the answer is given here. Investment in associate is 96.8. So can you kindly, guys, clap for yourselves? Because you've really been energetic in doing this. I'm even surprised. Clap for yourselves. Zoom has got a place where you can clap for yourselves. Zoom has a place where you can clap for yourself. You guys are tough people, and you're going to really master this thing. I can't see anybody clapping for them. I don't know why they don't. Perhaps they don't know how to clap for themselves. They don't know where the claps are. That's what I assume. That is what I assume. That's what I assume. That is what I shall assume. Great. Thank you so much. Thank you so much. Now, in your balance sheet, I would want you to do me a favor. Go to where we had investment in associate, and then you put that figure. Go to where we had investment in the associate, and then you put that figure. Are you able to see your balance sheet? The students who are there in the last class, are you able to see that balance sheet? That is where we have investment in associate. Please put that figure. Please put that figure. Please put that figure there. Put that figure there. Thank you so much. So we are only left with one working alone. Is there somebody who can remind us which working are we left with? If you look at your balance sheet, only one working for that question to balance. All my questions normally balance. If the day they will stop balancing, I will stop teaching. I'll stop teaching. We're only left with retained earnings here, group retained earnings, retained earnings. I'm only left with group retained earnings. Yes, thank you very much. Group retained earnings, yes. So group retained earnings. Although in an exam, you should never go for balancing. You know, it takes quite a lot of time to balance a question. In your exam, you only have how many minutes? 40. So you simply do what is doable. What is doable very fast, blah, 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 blah. You finish, you go on like that. Great. So then come here, ladies and gentlemen, and give us group retained earnings. So in the group retained earnings, I know there are only two things that will confuse students. In the group retained earnings, ladies and gentlemen, I would always want to have these UPS, the UPS, especially the downstream UPSs. Downstream. The downstream UPSs will feature here. the downstream UPSs for both the subsidiary and the associate. Downstream UPSs. These are the ones which confuse students. Otherwise, all the other things are very okay. They are very okay, because I'll come and talk over the parents retain the earnings as per the question. So as per the question, what is the parents' retained earnings as per the question? So as per the question, the retained earnings as per the question, the parent is Laurel. It has how much there? Retained earnings as per the question. You can see retained earnings 278. That is what it has. 278. And then you will come and add share of subs POP. Is there anybody who is able to remind us, ladies and gentlemen, POP, ya subsidiary, ilikuwa ngapi? Somebody who can make reference. We're done this. POP, your parent ilikuwa ngapi? POP, your parent ilikuwa ngapi? POP, your parent ilikuwa ngapi? Oh yeah. Angalia notes zako kama ulikuwa kwa last class, you should be able to tell us what the POP of the parent was. What the POP, post-acquisition profit of the parent was. Not parent, post-acquisition of their subsidiary, of Hadi. Somebody should be able to tell us this. 44, thank you very much. So it was 44, and if you recall, our percentage here as the parent, we own 80%. We own 80% of the subsidiary. We own 80% of the subsidiary. So can somebody in this case here give me post-acquisition profit? Post-acquisition profit. Is 44 after you have shared? Is 44 after you have shared? Or it's after you have shared? Eh? Is it possible you give me the one before sharing? The one before sharing, 55. The one before sharing was 55. When you multiply, we are getting 44 like that. And then come and give us, add share of the associates. The associates PERB. Remember, associate, we only have 40% of the associate. We only have 40% of the associate. And then PAP, of course, you know, PAP for the associate. We have just computed it up there. Associate is the comic. If I remember very well, it was 73. It was 73. If I remember very well, this was 73. 73. So what is 40% of 73? Remember, the parent owns 40%. So this is 29. Actually, you already have this. And then now, ladies and gentlemen, you will come and less the impairment loss. You less impairment loss of goodwill. And remember here, we take the parent's percentage. I'll be able to give you a very good secret here. So is there somebody who is able to see the impairment loss of goodwill? Not of the associate, of goodwill. Of goodwill. Impairment loss of goodwill. In the question, is there somebody who is able to see this impairment loss of goodwill? Impairment loss of goodwill. 15, isn't it? 15, and the goodwill belongs to who? Goodwill belongs to the subsidiary. So we can only take our percentage of the subsidiary, which is 80%. 80%. So 15 times 80% will give us what figure? Somebody, 15 times 80% will give us what figure? 15 times 80% will give us what figure? 15 times 80% will give us what figure? 15 times 80%. 15 times 80%. They're not talking to me. 12. Thank you very much. Now here, you will come again, less the downstream UPS. Less downstream UPS of the subsidiary. You also less downstream UPS of the associate. So I don't know whether, ladies and gentlemen, we were able to get these UPSs really. Were we able to get these UPSs? UPSs. We can compute them again. I don't mind really. I don't mind really. We can compute them again as we finish. Those are the last things now. We finish the entire question. Downstream. Let's come back here. Downstream UPS. So we have here, on 30th November 2019, Laurel, the parent, sold some goods to Hardy for cash for 32 million. These goods had originally cost 22 million, and none had been sold by the year end. On the same date, Laurel also sold goods to Comic for cash. So I would want somebody to calculate for me the UPS of this downstream for Hardy, for Hardy. Abracadabra, wacha nikupatie dakika mbili ujaribu tuone. Abracadabra, wacha nikupatie dakika mbili ujaribu tuone. Abracadabra, ndakupatia dakika mbili peke yake ujaribu. UPS alone, just UPS. I'm so sure UPS, you guys are very good at this. They're giving me answers. UPS is 10,000. The parent share, I'm being told, is 8,000. 8,000 for subsidiary. Great responses there. You guys are great. How about the subsidiary? Or rather, how about Comic? Comic, they're not talking to me. I'm just giving them 1 minute. They think through. Okay, for Comic already, I can see answers here. So 2.4 for Comic, 2.4 for Comic, 2.4 for Comic, and then we have 10, 10, 10, 10. So is Comic after you have taken our percentage? Is comic after you've taken, is the 2.4 after you guys have taken the percentage? For comic, is it after you guys have taken our percentage? Yes. So in this case here, for comic. So in this case here, for comic, ladies and gentlemen, for the associate is 2.4. And then for the sub, they are telling me it is 10. Let's first of all use 10 here. Let's use 10 here. Let's use 10 here. Let's use 10 there. I'll tell you why. Or rather, I just want to check something. Could you kindly come and give me the group's retained earnings here? The group's retained earnings. The group's retained earnings. Put 10 first, Irene. Put 10. There is something I want to see. Just put 10 there. Put 10 there, we see. Put 10 there, we see. Put 10 there, we see. So Leshamta is saying it is 326.2, 326.2.8. Just put 10 there. Just put 10 and calculate. Put 10 and calculate. So I'm being given a figure of 326 point what here? 0.8. 326.8. 326.8. Just put 10 there. I'll tell you why in a moment. Ladies and gentlemen, please listen. This working in a group consolidation, it is the most stupid working. Even in practice, we don't like it. We don't like it. I will never recommend anybody to do this working in the exam. This is a working that can make you fail. So normally what we do, listen and listen to me very well. I'll tell you what we normally do here. I'll tell you what we normally do in the group retained earnings before I explain to you exactly why I'm using that 10 there. Normally what happens in the group retained earnings is this. You see, we have our statement of financial position. All right. So we have our assets. Our assets, ladies and gentlemen, what do we have here? We have a property, plant, and equipment. We have goodwill. We have investment in associate. Investment in associate. And then straight away, you go to current assets, where, of course, even from this book, we are able to see a few current assets. So current assets, they've given us current assets already. Current assets that we have them here. Inventories, receivables, and cash at bank. So we have inventory, receivables, and the cash at bank. And then now we go to equity. So equity, what do we have here for equity? So for equity, we have the ordinary share capital. We have the share premium. We have in this case here retained earnings, and then we have a new kid in the block called retained earnings. We have a new kid in the block called OCI, called NCI, sorry, not OCI, NCI, non-controlling interest. After that, now I happen to be having the current liabilities where I can see trade payables. Now, I want you guys to do me a favor. This is a group consolidation question. Please do me a favor. I know you have done most of the things. Are you able now to give me the consolidated answers? What is the final answer of PPE? Take your calculator. Give me the final answer of PPE. Take your calculator. Give me the final answer of PPE. What do we have here? The final answer of PPE. Somebody who already has this. We are getting home. We are finishing now. So PPE. Already you had made adjustments, right? Already you had made adjustments. So yours is basically to go and read. 383. Woi, it's only one student who is giving me this figure. Woi. Then my figures may not balance. It's only one student who is giving me this figure. It's only one student who is giving me this figure. How about the other students? Remember, we had workings, eh? We had workings, 383. Thank you so much. How about the figure for goodwill? We had already computed this figure for goodwill. Goodwill, how much do we have for goodwill? Goodwill, 9. How about investment in associate that you have just done today? Investment in associate that you have just done today. Investment in associate that you have just done today, 96.8. How about inventory? Inventory. And I hope inventory, you guys have been able to subtract. Inventory, I hope you guys have been able to do any subtractions there of inventory. Let me see inventory. 608, right? Because you subtracted the 10. You subtracted the unrealized profit on stock. The 10. You subtracted that 10 there. 608. Thank you so much. Great. Now, how about this one here? Receivable. Do you have the figure for receivable? Do you have the figure for receivable? Do you have the figure for receivable? Receivable is 441. Receivable is 441. How about cash at bank? Cash at bank. How about cash at bank? Cash at bank, 52. 52. Ordinary share capital. Is there somebody who remembers the concept of ordinary share capital will only take the one of the parent? Is there anybody who is able to remember that ordinary share capital will take the one of the parent only? One of the parent only, one of the parent only, one of the parent only. You take one of the parent only, which is what here? Somebody, ordinary share capital of the parent. We don't consolidate here. 400, isn't it? So I'm being told here 400, 400, 400. The same case with the share premium. We take the parent figure only. Share premium, it's parent figure only, parent figure only. So for share premium, this is what we have here. So for share premium, ladies and gentlemen, we have the one of the parent only, which is 16. 16. 16. So in this case here, we have parent only 16. Retained earnings, you should never do this working. Not at all. Retained earnings will be my X. Will be my X. How about NCI? Can somebody in this case here give me the figure for NCI that we computed with you? NCI. Is there somebody who can give me the figure of NCI? NCI 47. 47. How about trade payables, ya mwisho? How about trade payables, ya mwisho? Trade payables are the very last one. How about trade payables? The very last one. Trade payables, the very last one. Trade payables, the very last one. Trade payables, the very last one. 800. So then I would want you guys to do me a favor. Could you kindly give me the figure of total assets? Are you able to add the total assets for me? Is there somebody who can add these total assets for me? Is there somebody who can add the total assets for me? Total assets, total assets, total assets, total assets, total assets. What do we have here for our total assets? People are not talking to me. Total assets. Total assets, 1589.8, isn't it? 1589.8. 1589.8. How about your total equity and liabilities? Total equity and liabilities. Of course, I know the answer will be X plus. I know the answer will be X plus because I have these others. I have this, I have this, I have this, I have that. So can you kindly add these four figures for me? This, and that. So it will be X plus that. $12.63. Is there somebody who is able to confirm that this is 12.63? 12.63, 12.63. Great, great, 12.63. Thank you very much. But again, you know something for balance purposes that this must be equal to who? Must be equal to that. So you're saying here that X plus 12.63 should be equal to 1589.8. So then what is our X? It will be 1589.8 minus 12.63, which will end up giving us what figure? because when this goes over, it will become a minus. It will become a minus. So when we subtract, what shall we get at the end of the day, ladies and gentlemen? When you subtract, what shall we get at the end of the day? They're getting 326 point what here? 326.8. And now this is your retained earnings. These are retained earnings. So what you will not do, don't put this as a, you can write this X here with what here, a pencil. So that when you get this figure, you will simply come and rub this, you rub this, you rub this, and write there 326.8. How does Kasneb mark? Of course, it's 1, 1, 1, 1, 1, 1, like that. So that you avoid doing any working of retained earnings. For the many years I've marked, you'll never get any student who gets marks for retained earnings, never. You will confuse yourself, it will be a waste of time. Retained earnings should be the only thing that is left as our X unknown, and you evaluate it using this approach, like that. Without much illustrations like why did we not take a percentage of our UPS for that? No. The very best, that working will never even do it. This is how we shall be tackling this. Great. So I think, ladies and gentlemen, we have done justice to this particular concept of investment in associate. So if I was to take a break, and of course, not even a break, but I call this session to an end. But before I do that, I have to invite all the new students to choose studying online with us. And as usual, if you want to talk to us, our number is 0793 555 000. And of course, this video, I'll be able to hang it on YouTube when you sit there. Ensure that you subscribe and share it with your friends. Good things are always free. You share them like that, so that you can also get an opportunity of taking your teacher where upstream there in terms of matters of academia. Otherwise, thank you very much. I want to believe that we have gotten something. I want to believe that we have gotten something out of this. Great, great.